Gold is screaming. Not literally, of course, but if you know how to listen, the message is deafening. Right now, while most people are distracted by headlines about politics or celebrity drama, the oldest form of money on Earth is sending us a warning that could save your financial future, or destroy it if you ignore what's happening. Gold just shattered every record in the books. We're talking about a metal that has been trading for thousands of years, suddenly rocketing to levels that would have seemed impossible just months ago. The price hit an all-time high of over $4,000 per ounce. That's not a typo. $4,000. For context, gold was trading around $1,500 just a few years back. This isn't normal market movement. This is panic buying disguised as prosperity. But here's what nobody's telling you. When gold moves like this, it's not celebrating. It's mourning. It's mourning the death of confidence in everything else. Every spike in gold's price is a vote of no confidence in the systems we've been told to trust. The banks, the currencies, the promises that our leaders make about economic stability. Gold doesn't lie, it can't be printed, manipulated, or wished into existence. And right now, it's telling us something terrifying. Professor Paolo Pasquariello from the University of Michigan put it bluntly when he said there's no way you can interpret these exploding gold prices as a good sign. They're a warning sign. When an academic who studies financial markets for a living uses words like exploding and warning in the same sentence, you should probably pay attention. Because while everyone else is celebrating stock market gains and talking about soft landings, gold is preparing for a crash landing. The numbers don't lie, even when politicians do. Gold has surged more than 25% since the start of this year alone. That's not growth, that's desperation. In the past few months, we've watched it climb nearly 20%, far outpacing the stock market that everyone keeps pointing to as proof that everything is fine. But gold knows better. Gold remembers what happens when systems built on debt and promises finally buckle under their own weight. What makes this surge particularly ominous is its timing. This explosion in gold prices has coincided perfectly with data showing a sharp slowdown in the job market. Employment numbers that used to look solid are now being revised downward, the kind of revisions that happen when reality can no longer be hidden behind seasonal adjustments and statistical manipulation. When people start losing jobs and gold starts hitting records simultaneously, history tells us what comes next, and it's not pretty. Central banks around the world are quietly confirming what gold prices are screaming about. They've been buying gold at record levels, accumulating over 1,000 tons in each of the past 3 years. These aren't random purchases by nervous investors checking their portfolios after dinner. These are calculated moves by the people who control national monetary policy. They're the ones who print money, set interest rates, and supposedly know what they're doing. And they're abandoning their own currencies in favor of the one asset they can't create out of thin air. Think about that for a moment. The people who run the printing presses are buying the one thing they can't print. Central bankers in China, Russia, India, and even some Western nations are stockpiling gold like it's the last lifeboat on a sinking ship. If the people who control money are running toward gold, what does that tell you about the future of money itself? The United States dollar, the so-called king of currencies, is showing cracks that would have been unthinkable just a decade ago. Its share of global reserves has fallen to its lowest level since 1994. That's 30 years of steady decline in the currency that's supposed to be the foundation of the global financial system. The dollar has lost more than 11% of its value in just the first half of this year alone. That's the biggest decline in over 50 years, according to Morgan Stanley. 50 years. But this isn't just about numbers on a chart. This is about the unraveling of a system that has kept the global economy functioning since the end of World War II. When the world's reserve currency starts losing its grip, when central banks start hoarding gold instead of dollars, when the oldest form of money starts setting records while everything else starts showing stress fractures, you're witnessing the early stages of a monetary earthquake. The technical analysis paints an even grimmer picture. Gold is trading in ranges that suggest either a massive breakout to even higher levels or a catastrophic correction that could trigger panic across all markets. Support levels are holding for now, but the patterns emerging on the charts look eerily similar to what we saw before previous major market disruptions. Double tops, triangular convergence patterns, and oversold conditions that could snap back violently in either direction. If gold breaks below key support levels around $4,000, technical analysts warn we could see a rapid descent that might not stop until it reaches $3,800 or even $3,600. That kind of correction doesn't happen in isolation. When gold crashes after reaching these extreme levels, it usually takes everything else with it. Stocks, bonds, commodities, even cryptocurrencies tend to follow gold down when confidence finally breaks. But here's the truly frightening part. The recession probability models are flashing red. Moody's Analytics now puts the chance of an economic downturn at 48%. That's the highest it's been since the pandemic lockdowns of 2020. Mark Zandi, their chief economist, called these odds uncomfortably high, noting that once the probability crosses 50%, a recession usually follows. We're essentially one bad jobs report or one financial shock away from crossing that threshold. The labour market, which politicians love to point to as proof of economic strength, is showing signs of serious strain. Job creation has slowed to under 100,000 new positions per month for 4 consecutive months. That's the kind of pace that historically coincides with recessions. The government recently revised down job creation numbers by over 900,000 positions. 900,000 jobs that they said existed, but didn't. That's not a rounding error. That's evidence of an economy that's been running on statistical fumes rather than real growth. Meanwhile, the stock market in gold terms has plunged to its lowest levels since the pandemic panic of 2020. When you measure the S&P 500 against gold instead of dollars, you get a clearer picture of real wealth creation versus monetary inflation. And that picture shows stocks losing ground rapidly against the one asset that can't be manipulated by central bank policies. Oil prices have fallen significantly this year, which normally, and the economy. But in would be good news for consumers this context, falling oil prices suggest weak global economic growth rather than increased supply. When the world uses less energy, it usually means the world is producing less, working less, and growing less. That's deflationary pressure that conflicts with the inflationary pressures still present in food prices and the impact of trade policies. This creates the worst possible scenario for policymakers. Inflation that won't go away completely, combined with economic growth that's slowing down rapidly, it's the kind of environment where traditional monetary policy tools stop working. Lower interest rates might not stimulate growth if businesses and consumers are already over-leveraged. Higher rates might trigger the recession that everyone is trying to avoid. The global economic indicators are painting a picture of an economy that's been held together by monetary policy and government intervention for so long that nobody remembers what normal looks like. Leading indicators of economic activity have been declining for 3 years and are now falling into negative territory. That's not a temporary slowdown. That's a structural shift that suggests the foundation of our economic growth has been compromised. Gold's meteoric rise is not just reflecting current uncertainty, it's anticipating what comes next. Several analysts are now projecting that if a full recession materializes, gold could surge another 10 to 25%, potentially testing the $4,500 range within the next 12 to 18 months. But here's where it gets dangerous. Jim Wyckoff, a senior market analyst at Kitco Metals, issued a stark warning that should make every investor pause. He said gold and silver are in a boom cycle right now, but you can bet they'll be in a bust period sooner than investors expect. That's the trap nobody talks about. Gold's current surge isn't just a safe haven play, it's a bubble forming in real time, fueled by the same kind of panic that creates every financial disaster. When everyone runs toward the same exit, that exit eventually gets blocked. And when gold finally crashes from these astronomical levels, it won't just hurt gold investors. It will signal that the last refuge of financial safety has been compromised. The Elliott wave analysis suggests we're seeing a complete pattern that technical analysts call a double 3 formation. If this analysis is correct, both gold and silver are positioned for a massive bearish move that could unfold within days or weeks, not months. The strength of the previous upward wave suggests the coming downward correction could be equally dramatic. We're talking about potential declines that could erase months of gains in a matter of trading sessions. But the crash scenario gets worse when you understand the interconnected nature of modern markets. Gold doesn't exist in isolation anymore. Exchange-traded funds, derivatives, and algorithmic trading have tied gold's price movements to virtually every other asset class. When gold experiences extreme volatility, that volatility spreads through the financial system like a contagion. Consider what happened during previous market crises. In 2008, gold initially fell alongside everything else as investors scrambled for cash. It was only later, after the initial panic subsided, that gold began its long climb higher. But this time is different. This time, gold has already climbed to extreme levels before the crisis has fully materialized. That means when the crash comes, gold might not provide the protection that investors are counting on. The Federal Reserve finds itself in an impossible position. They've kept interest rates artificially low for so long that any significant increase could trigger the recession they're trying to prevent. But keeping rates low while inflation persists means the dollar continues to weaken, pushing gold prices even higher. It's a monetary policy death spiral where every action creates worse consequences down the line. International developments are making the situation even more precarious. Trade tensions, geopolitical conflicts, and currency wars are all contributing to the flight toward gold. But these same factors are undermining the global economic cooperation that's necessary for financial stability. When nations start hoarding gold and abandoning international monetary agreements, the entire system that has supported global trade for decades begins to fracture. The velocity of money, a key indicator of economic health, has been declining steadily. This means that even as central banks create more money, that money isn't circulating through the economy at normal rates. People and businesses are hoarding cash and converting it to assets like gold rather than investing in productive activities. This creates a deflationary spiral where economic activity slows down even as asset prices inflate. Corporate debt levels have reached historic highs, with many companies borrowing heavily during the years of low interest rates. As borrowing costs rise and economic conditions deteriorate, these companies will face refinancing challenges that could trigger a wave of bankruptcies. When major corporations start failing, the ripple effects spread through employment, consumer spending, and investor confidence. The housing market, which has been propped up by low interest rates and government policies, is showing signs of serious stress. Mortgage rates have climbed significantly, pricing out many potential buyers and leaving sellers with properties they can't move at expected prices. A housing correction would devastate household wealth for millions of Americans who have most of their net worth tied up in real estate. Personal savings rates have declined as consumers have been forced to dip into reserves to maintain their standard of living amid rising costs. Credit card debt has reached record levels, with many households carrying balances they can't afford to service if their income declines or their expenses increase further. This consumer debt overhang represents a massive vulnerability in the economic system. The commercial real estate sector faces an even more severe crisis, as remote work patterns have permanently reduced demand for office space. Billions of dollars in commercial real estate loans are coming due for refinancing at much higher interest rates, and many properties are worth significantly less than their outstanding debt. This could trigger a banking crisis similar to what we saw with residential real estate in 2008. State and local governments across the country are struggling with budget deficits, unfunded pension obligations, and declining tax revenues. Many municipalities are facing the choice between raising taxes, cutting services, or defaulting on their obligations. Municipal bond markets, once considered among the safest investments, are showing signs of stress that could spread throughout the financial system. The international monetary system is fracturing as more countries abandon dollar-based trade arrangements in favor of bilateral currency swaps or commodity-based exchanges. This dollarization process accelerates the decline of American monetary influence, while increasing demand for alternative stores of value like gold. Each country that moves away from dollar reserves weakens the entire system that has supported American economic dominance. Financial institutions are reporting increased loan defaults across multiple sectors, from commercial real estate to consumer credit. Bank stress tests, while officially showing adequate capital reserves, may not account for the rapid deterioration in economic conditions that's currently unfolding. If a major financial institution fails, the contagion effects could trigger a systemic crisis worse than what we experienced 15 years ago. The derivatives markets, worth hundreds of trillions of dollars globally, remain largely opaque and interconnected. These complex financial instruments amplify both gains and losses throughout the system. In a crisis scenario, derivative positions that were designed to hedge risk could instead magnify losses and spread panic across international markets. Gold's surge is not just predicting a market crash. It's actively participating in the creation of conditions that make a crash inevitable. When the world's oldest form of money reaches these extreme valuations, it signals that confidence in everything else has eroded beyond repair. And when that confidence finally breaks completely, the resulting collapse will make previous financial crises look like minor corrections. The warning signs are everywhere, flashing red across every indicator that matters. The only question remaining is whether you'll recognize them in time to protect yourself, or whether you'll be caught off guard when the system finally breaks under the weight of its own contradictions. So there you have it. Gold isn't just hitting record highs, it's screaming a warning that most people will ignore until it's too late. The metal that has survived every empire, every currency collapse, every financial disaster in human history is telling us that we're standing at the edge of another cliff. And this time, there might not be a safety net waiting below. The signals are clear if you know how to read them. Central banks hoarding gold, the dollar losing its grip, recession probabilities climbing toward 50%, job numbers being revised down by nearly 1 million, technical patterns that mirror every major crash in the past. This isn't speculation anymore. This is the mathematical certainty of a system that has borrowed too much, promised too much, and printed too much money to ever make good on its obligations. History doesn't repeat, but it sure does rhyme. And right now it's rhyming with every financial collapse that came before. The only difference is the scale. This time, when the dominoes start falling, there's nowhere left to run, because gold, the ultimate safe haven, is already pricing in the disaster that hasn't happened yet. The question isn't whether a crash is coming. The question is whether you'll be one of the few who saw it coming, or one of the many who trusted the system right up until the moment it failed. Gold has given you the warning. What you do with it is up to you.